Good afternoon and welcome to our webinar on our fund, how it's performing, the properties we've been buying, and answering your questions. That there have been many, so we love that. Bring them on. And I love doing it in a forum like this where you can hear other people's questions because it might be a question you didn't think about before. If you haven't seen any presentation, then we're so excited. We're going to be giving a market overview, but a little bit different than what we've done in the past because we're looking at some different parts of North Texas. So again, welcome to our Real Income Properties Texas 1 LLC update. All right, so disclaimer, you have heard this one before. It's a little bit different than what we do at Real Wealth. Just want to make sure that you know that this is not an offer to sell, nor a solicitation of an offer to purchase securities. The offer is only made through the Private Placement Memorandum, which will be the most exciting read you've ever had and will definitely give you a great night's sleep. You can find it at growdevelopments.com. And that's where you always want to make sure that you read carefully what's in the PPM and what's in the operating agreement, because what you maybe thought you heard may not be accurate, right? What it is and the deal, the legal documents are the operating agreement and the PPM, and that's where the offer is. And again, you can get that at growdevelopments.com. The strategies mentioned in the presentation may not be appropriate for you. That's why you always want to talk to your CPA for sure. If we get a lot of CPA questions, I could tell you the response will be talk to your CPA, give them the PPM and the operating agreement so that they can tell you how it will affect you, because it's going to be different for everyone and depends on what money you use. If you're using IRA funds or it's just going to be different. So make sure that you run that by your professionals. And then, of course, past performance is no guarantee of future results. We're going to be talking about what we know from the past and what's going on right now in the market. But of course, it's anyone's guess what's coming. But we have a good guess. We have a good idea of what's coming. But of course, there's no guarantee. And real estate purchases are always subject to investment risk, including possible loss of amounts invested. Although I will say, buying an already existing property is so much less risky than new construction. And when I say new construction, I'm not talking about building a house. I'm talking about all the development of raw land can be extremely risky. It's probably the most risky. So, buying already existing properties, I love that about this fund. All right, and today's agenda, meet the team. I mean, here we are. Leah Slaughter, many of you know her. Welcome, Leah.
Thank you.
And then we'll do a market update, and this will be a little bit different than the market updates that you've seen. It's also changing. It's so funny, just in the few minutes that Leah and I were talking before this broadcast, she's telling me how things are changing in this moment. So this will be a good market update for everybody and certainly for new investors. And we'll look at the current assets that the fund has purchased. Very, very exciting. I got to see a few of them when I was there, and I can't wait to go back. And then fund details, and then how to subscribe to it if you haven't already. All right, and then I hate to do this, but it is what it is. It's security law that we're following, and in this investment, it's only allowed to accept accredited investors only. And that means that you have a net worth over $1 million, excluding your primary residence, individually or with a spouse, or income. These are all ors. So you just need one of these three. Or you have income over $200,000 as an individual, or $300,000 as a spouse or partner in each of the prior 2 years. So you don't have to have that $1 million net worth if you have this income. And then investment professionals, this is new. This is a fairly new description of accredited investor. Investment professionals in good standing holding the general securities representative license of Series 7, the investment advisor representative license of a Series 65 or a Series 82. You're also eligible. All right, so about Leah, she was born and raised in the Dallas-Fort Worth metro area. She knows it so well. She's co-founder and owner of her company since 2006, owns multiple companies, has 4 adopted children. It's amazing, and very involved in community and nonprofit agencies, national real estate speaker on radio and events and articles and in news, and just owns approximately $40 million in real estate. That's all. So I think she knows a thing or two about Dallas and about single family home investing. So again, welcome, Leah. We're so happy to be partnering with you on this fund. So with this,
Thank you.
I'm going to definitely hand it over to you to tell us what's going on in your market.
Yeah, so I think the first thing I want to talk about is a little bit about what's happening with our size and our population growth. If you're watching the news, you're seeing the mass exodus from areas like California and New York. And of course, a vast majority of those people are coming here. But it's not just North Texas. I, of course, want to take a moment to say Texas overall is doing very well, and Texas overall is growing significantly. So we are now the second largest state by population. So you'll see that we're behind only California. We actually, a lot of people don't realize that we're larger, significantly larger than both Florida and New York. So this is, and again, this is all updated new data. So we're going to be talking about things that have come out in the last couple of months because there has been a lot of positive news and a lot of changes in our market. So let's talk about that. So we are the most populous metro in Texas and in the southern United States. Our population's almost doubled since 1990. And I've talked a lot about how we're about to overtake Chicago. We're not exactly sure when, because every time we think we have a date, we continue getting all this mass immigration and movement here. So it'll be interesting to see when that actually happens. But sometime around 2030, we will be the third largest metro in the United States. We are currently the fastest growing metro in the United States. This is, again, new. And you can see here that we surpassed both New York and Los Angeles in percentage of jobs added. So we saw 6.5% job growth in the year ending in October, which is incredible. We're talking 100,000 jobs here. So we're going to talk about a lot of what those changes are, what the pay of these jobs are, and how it's a really unique dynamic for us relative to, let's say, New York, LA, Chicago, cost of living, what the average income is, and what the average price per home is. And so I'm going to talk a little bit about some of the things that it's talking about here, but the takeaway here is we're large, we're growing quickly, and that we're extremely diverse in our employment sectors, which is one of the reasons why we're such a strong, stable market. So just some basic facts. We're home to over 70,000 businesses and 10,000 corporate headquarters, 45 Fortune 1000 companies, 2,566 companies with more than 100 employees, 23 Fortune 500s. Unemployment hovers around 3.3%, no state or corporate income tax. Our enterprise fund is $650 million to attract businesses to Texas. These numbers are actually much larger now. Just the deal that was done with Texas Instruments we're going to talk about in Sherman is astronomical. But we've basically quadrupled the size of this fund in the last few years. And you have to remember that this is incentives to get companies to come here, to relocate here, tax incentives. They're building mini cities for some of these companies with apartments and transit systems and all sorts of things. So if you haven't looked up the Texas Enterprise Fund, I strongly recommend you do that. We've created over 1 million jobs since 2010, 121,000 in 1 year alone. And the home sold price per foot is up 45% in the last 3 years, and that is data as of December. So let's talk about this population growth and what that means. Of course, I can talk to you about how we're undervalued. I can talk to you about all the reasons why I think DFW is a great investment opportunity, but let's just look at sheer numbers. So you can see where we are as of 2022 and where they're projecting by 2045 at 11.3 million people. That's an increase of over 8 million people from where we are today in under about 22 years. So very, very significant growth. What I think is really the takeaway here is the number of new households that this is going to create. We're talking over 1.5 million new households. We also have the largest percentage of young people and people coming of age. And so this doesn't even take into account the number of new households that are going to be aging into adulthood. We have what's called a baby boom here, and that's playing a significant role as well, because we have to not only look at what the relocation is bringing, but what our own citizens are creating in this new baby boom. So if you go to the next slide, we need essentially 300,000 square miles of space for basically these buildings to happen. And so 918,000. Yeah, it's crazy numbers.
Wow.
It's crazy numbers. And you have to remember that a lot of these people coming here, they're not going into entry-level housing, right? So they're not competing against these $250,000 homes. These are high-paying jobs. And so the drive and the build has been these very expensive homes, and that's what's hurting that kind of entry-level market right now. So this kind of talks about what I've been saying about this housing shortage. It's not a little housing shortage, it's a massive housing shortage. So basically what it says is we were the 8th largest in the terms of construction growth, but of course we're number one growth, so we should have been number one. And when I was presenting last time, we were talking about 2021 numbers, and we started about 50,000 homes. You'll see that's actually down significantly. We're down 16.2% from 2021. Only 48,700 and some change homes were started. However, our population grew by 21.1%. Housing only grew 15.9%. So we're talking about almost a 6% gap in an already massive housing shortage. As of today, we're estimating over 85,000 homes we are short. And keep in mind, a huge chunk of that need is right now being filled by apartments, which are skewing those numbers. So we are not providing enough housing, not only to make up for this housing shortage that we've been in, but also it's increasing every single year. And that's really scary. That's really, really scary for people who are looking to buy property here or rent property here as homeowners. So looking at month-end numbers for December, we have 2.2 months of inventory across our metro as a whole. Keep in mind a balanced market is 5 to 6 months, and so we are certainly not in a buyer's market. No one can say that there hasn't been a pause the last few months, and so we're very aware of that because of interest rates being high. What I'm here to tell you is that we are doing very well through this pause, and I use that word very lightly, but we're already seeing multiple offers again. I was just talking with Kathy about this. Our market's picking up very quickly. And so, we typically see prime season as our busy time and off season is slower. And I've been talking about that for years. And so the question was, when we came out of off season, what was it going to look like? Were we going to be seeing some of what the rest of the country is seeing? And we're really not. The fact that we're already seeing multiple offers again is a little scary to me because rates are still pretty high. They're coming back down, but they're still pretty high. And so that leads me back to wonder, when rates do come down back to 5.5%, how crazy are we going to get? Are we going to be back in that market where people are paying significantly over asking and there's 3 people for every 1 house? That's yet to be determined, but I certainly think that we've been very strong. There's been no value loss over the last 60 days, and so while a lot of other markets have seriously struggled and values have gone down, we have not seen that here. Our median price is still only about $575,000 for the hottest county in DFW. Keep in mind, 3rd largest metro, and we're still talking about our most desirable areas under 600,000 average. So again, just significant undervaluing based on market size and now income as well. So rental home days on market are still lower than January 2020 pre-COVID, and rents have gone up 26% in the last 30 months. And again, these are numbers as of last month.
Wow.
So our economy is on fire. I love this headline, and it really is true. This is a brand new article. Texas overall added over 650,000 jobs in 2022. We led the way among all the large metros. We actually added more jobs than 46 states did. It's pretty crazy. And again, it's because everyone wants to be here. We've got the right climate, we've got the right weather, we've got a large area to build in where you can live 40 miles from your employer and get there in a half hour because of our amazing highway systems. There's just a lot of really cool things happening right now that are driving these people here. So DFW added more jobs, as I mentioned, in 46 states. That's 36% of Texas's net gains. And that's just DFW, keeping in mind that Houston is also a massive area. And it's really incredible. So North Texas posted a net increase of over 235,000 jobs last year, seasonally adjusted. That's more than double the average gains in the years before COVID. Pretty much matched the total of 2021 when the economy was rebounding from the loss of over 100,000 jobs. So essentially what this means is the year before we were rebounding all those jobs we lost, and yet somehow we've managed to keep up with that pace. So pretty incredible. Pretty incredible. Any argument that our recovery was just from COVID is completely dispelled at this point. This is big news. So this just happened as well. The National Association of Realtors came out with their predictions for 2023, and they essentially said that there's a few cities that are going to continue to do well and everyone else kind of up in the air. Well, of course, North Texas is in that top 10. We're actually number 3, and they are calling that they believe home prices will climb by at least 5% in 2023, and they're expecting rent prices to climb at least 5% and possibly more. So obviously we see NAR as pretty conservative, but we're very excited that they see the same potential and opportunity here in North Texas that we see as well. So again, we have an amazing economy and it's extremely diverse. And so really what we've been seeing is this mass GDP growth and also continued diversification of our employment sectors. So as of right now, we make up about 2.7% of the country's GDP. We saw 3.1% growth in our GDP in this last year, which is incredible coming out of COVID. A lot of areas saw decreases, and yet here we are with, you have to think about market size, economy size, 3.1% is massive. That's an absolute massive growth. And so again, that diversity across industries and the getting employers to come here and businesses to relocate here, then their partner companies come here, exactly what we're seeing in Grayson County that we're going to talk about. So it's just kind of like a domino effect. One comes, another comes, and then others come, and it's kind of like an unstoppable force at this point. So I think one of the biggest takeaways of what's coming here is how it's changing our average income. And so what's interesting is it really creates an affordability among middle class for both rental property and for purchasing, despite what I think a lot of the other top metros see. So 49.27% of the people relocating here earn more than $150,000 a year. I can tell you for North Texas, that is a massive, massive income. And so coming out of New York and coming out of LA, that doesn't seem like a lot, but here, that's astronomical. But really the biggest takeaway from this is less than 17% earn less than $75,000 a year. That is incredible. So we've got this massive amount of people moving here, jobs coming here, and yet these jobs are higher paying than what's already here. And so that affordability, and this is what really led into a lot of what our market did in the last 12 months with multiple offers and cash purchases. And so many of these properties being bought by investors is because they know what's coming here is a higher value that's more in line with the fourth largest market and really where we should have been all along. So it's not just appreciation that we're anticipating and that we're hoping on. You know, we don't have crystal balls, we can't make guarantees, but a lot of this is just an artificial kind of deflation of prices that has existed because of our land mass and because we were kind of the underdogs that nobody realized we were so large. And now what's happening is it's kind of unmistakable. You can't miss it anymore. And so our prices are adjusting more in line with where they should be for a top market. But of course, at under 600,000 in the areas we're dealing in, still picking up properties sub 200,000, we have a lot of room potentially to move upward. And that's what we're all very excited about. And certainly my 40 million in real estate speaks to that. So this is another just kind of interesting look at what we're expecting for rent prices as well, because of course, anytime we're dealing with investment acquisitions and holds, it's not just about the end play. It's not just about hoping for appreciation and a sale value that's higher than where we came in, but it's also the ongoing cash flow during the term of ownership. And that's whether you're investing in a fund or whether you own your own rental properties. And so pretty much everyone is expecting above average rent price gains in 2023. So the Federal Reserve Bank of Dallas forecast is calling from 5.8 to an increase of 8.4% as of May. So again, they too, just like NAR, are calling for rent increases and rent growth rate of 5 to 7%. That's coming from Moody's. So your top analysts are looking at these markets and seeing growth. And that's because, again, housing shortage, it's supply versus demand, and it's just the number of people coming here. There's just not enough property. And so at some point, those prices have to adjust. So as I mentioned, DFW gained over 235,000 residents in the last 2 years. 21 cities grew more than 10% during the pandemic. We've seen rent growth, massive home price appreciation. And so we want to target these markets that are around those inner cities, all these suburbs that jobs are going into. Most of the areas that we're looking at, they have their own employment centers and their own large employers, but they're also drivable into the main northern metro counties like Dallas County's northern side, Collin County, where all of these employers are coming in. So Frisco, Plano, McKinney, that's all Collin County. And those are those areas that we're piggybacking on. So we're the next county to the north, the next county to the east, the next county to the west. So we're drivable into those massive city centers, but also targeting suburbs that have their own massive growth. And we haven't even started talking about chip manufacturing and what's happening here in Grayson County. So with that, let's talk a little bit about what we're seeing.
Okay.
So Grayson County, any of you who have heard me talking know that Grayson County is my favorite area. You know that 80% or more of my portfolio resides in Grayson County. And there's a lot of reasons for that. You know, we knew with Texas Instruments being up there, and we knew with Finisar being up there, that there was a huge potential for large growth. And that's because it's just 30 minutes away from the main areas of Collin County, only 55 minutes or 60 minutes from downtown Dallas. So very connected. But we knew this was going to become a tech corridor, and we really hoped that what was going to happen is more tech companies were going to start coming in. Even I, as positive as I've been on Grayson County, did not see what was coming. I did not see this incredible, incredible opportunity that's created up in Grayson County. I'm very glad that we were buying up there and selling up there, but I don't think any of us could have foreseen how big it got. I don't think we expected the Senate bill we're going to talk about. I don't think we expected for all of these manufacturers to come in at the same time. COVID pushed everything over the top because chips were scarce. We couldn't get the things we needed for our cars, our cell phones, everything else. And so this massive push to bring this chip manufacturing back to the United States happened because of COVID. And it took what was already a massive opportunity and just put it over the top. So let's talk about that. So essentially, there's so many new names for it. Silicon Alley, Silicon Prairie, it doesn't really matter what you call it, but at the end of the day, we are becoming a new Silicon Valley. And it's really this whole stretch between Sherman and Denison where chip manufacturing and all of these companies are coming in and building massive warehouses and factories to build these chip wafers. And it's really an incredible thing to think that it's happening here, but it's also very strategic, right? If they'd gone into the city of Dallas, down into the main area, which that's not where employers are going, they're all pretty much going to the suburbs, but it's way cheaper to go a little bit north. And then in addition to that, when you've already got TI up there, you already had Finisar up there, if you streamline operations and you bring the other companies that you work with around there where you're sharing parts, the distribution to get things there is cheaper. So it seems kind of out of the ordinary, but it's actually extremely strategic because the land was available and it was cheaper and they were able to bring their people in there to work and to live, and it was a lot cheaper for them too. So I'd like to say I'm surprised. I'm certainly surprised by the magnitude, but what's coming and it's just starting is incredible. So in the past year, the city of Sherman, 45,000 people, has landed 2 multi-billion-dollar projects, cementing its place as a semiconductor manufacturing hub. Global Wafers is building a $5 billion silicon wafer plant, and Texas Instruments is investing $30 billion into a complex that's building the chips themselves. This is the single largest economic deal in Texas history, part of the Enterprise Fund. And they're saying that the population is going to double in the next 5 to 10 years. And the development plan calls for over 8,000 new homes, 8,000 new homes for a city of 45,000, tiny little town. Imagine how that's going to happen. So the opportunity here is huge. This area that has been an older railroad town that has just started revitalizing in the last 10 years, now we're talking hundreds and hundreds and hundreds of top paying jobs and executives, and where are they going to live? Where are they going to shop? Where's their Whole Foods going to be? Where are their restaurants going to be? What is that going to do to this town, this area? And more importantly, what is it going to do to the price of homes becoming this luxury community that's going to happen from all of this? And that is, of course, exactly what we're banking on. So this is kind of the schematic layout of what they're building right now. If you haven't been out here for a tour lately, we have some incredible things happening up there off 75. Come up here, see what's happening. Come look at what's being built and the size. You cannot imagine the size. It's as far as the eye can see for these plants that are coming in. So as I mentioned, largest private sector economic development in Texas history. And essentially, they think this is just the beginning, and they think it's just the beginning. So the Senate bill just passed. One of the deals was already struck before that. The second was being struck as that was happening. And now the Senate deal is going to give the incentives for even more to come. And so I think we are just getting started. And again, because everything's already centrally located up here in Sherman Denison, where there's all this land and all this availability, I think it's extremely likely that more of them are going to come into the exact same area. It's going to be cheaper for them to do it that way. And so I do think that's coming. So this is that Senate semiconductor bill we were talking about. And again, just incredible. This legislation is sending more than $52 billion in subsidies and tax credits to companies that build semiconductors in the United States. That's B, 52 billion. So Globantech is 1,500 new jobs and a $5 billion investment to start. Texas gave a 15 million cash grant from the Enterprise Fund plus 34 million in tax incentives. It's the first manufacturing plant of its kind in America in the last 20 years. If nothing else, as an American, I'm proud to see this happening. I think it's really neat that we're bringing this back to the United States. And, you know, given that I think COVID has taught us all we don't know what's coming out of left field, it's great to know that we're going to have some of this manufacturing back here so that we can actually have cars to buy, you know, the simple things that we don't think about.
Yeah.
And then, of course, as all this money comes into the area, we start to see the development changing, right? And so this is the state-of-the-art new Sherman High School that just opened. And I typically don't talk about schools, but I think it's important that you see the widespread effect that this money and the growth is having. Now, of course, the tax base has increased too, and thankfully the county did a tax decrease in the amount of the increase of what the bill would have been for values increasing to help their citizens out, not have to pay extra taxes. I think the average citizen paid like an extra $18, so really quite incredible. But we've seen that across North Texas. Pretty much all of our areas are dropping their property tax rates right now because values have gone up, and so we have way more money than we know what to do with. Even the small little town I live in of 5,000 people had a huge tax decrease. But I want you to see here this incredible high school, and the takeaway from this is about their STEM careers that they're doing. They built an entire STEM and STEAM center. They're partnering with Texas Instruments, preparing people for these tech jobs at Sherman High School. And this is just one of the projects that's happening right now. The downtown in Denison is being completely revitalized completely. And it was already beautiful, but they've got it all ripped up, all new roads, tons of new businesses, lofts. It's just an incredible opportunity. And these areas have a huge shortage of apartments. You go drive through these areas, there's virtually no new multifamily. I think there's one development that they keep adding on to, and a lot of older small developments, but this area has been virtually untouched from the multifamily sector, which is why there's going to be such a big housing shortage and need as all these businesses get up and running and these new 5 to 10,000 jobs start overnight. As of right now, the median existing home sale price is $300,000 and new construction sale price about $327,000. And I'm going to show you a little bit bigger breakdown of how that looks changed over the last decade coming up. So home values in Sherman, the 1-year price change is $47,000. The 5-year price change is $123,000. Typical home value $271,000 as of December 2022.
Wow.
Now we look at Denison, 1-year price change $40,000, 5-year price change $111,000. Typical home value about $235,000. So again, the price changes going on are significant here. And what we expect to continue as this area grows and as more of these people come in. The city has done a lot of things, especially Denison City Council, to try to slow down this infill work that we all do up here. And that's, they want to increase the tax base. They want more expensive properties. They want to raise the overall value of homes. And what that means for those of us in entry-level homes is that our values go up. And so, again, we don't have a crystal ball, but it's just sheer economics. That's what we're expecting. So this is one thing I do want to point out about the Sherman-Denison Metro. And so it's part of DFW, but they're big enough. They're kind of their own metro too. I want you to see that our manufacturing jobs are already 6 times the national average before all this happens. But look how diverse the economic climate is up here in Grayson County, one of the areas that we're targeting. And this is a perfect snapshot of why North Texas is so stable. If you look down at Houston and other areas, there's large parts of the pie that are one industry. So when that one industry suffers, if you look through the last crash where Houston got hit so hard, if you looked at oil and gas and energy sector, it would have been a massive piece of this pie. But you look at North Texas, you look at Grayson County specifically, it's extremely diverse, extremely stable. But we already have 6 times the national average in manufacturing, which are, again, those high paying jobs. And look at what's coming. City of 45,000 with 5 to 10,000 jobs overnight. It's a pretty significant change. So again, just a lot of opportunity up here. So median list price right now in Grayson County, and this is as of the end of December 2022, is $339,000. Difference is still going up. So obviously the gains have slowed a little bit, but we're still up year over year. And these areas have stayed extremely strong through this kind of interest rate pause that's starting to come down now. But here's what I want you to look at. I want you to look at the homes for sale by bedroom count. So if you look at 3-bedroom homes, which is kind of our standard entry-level home, I want you to look and see that we are not growing to keep up with what's happening. But where we are seeing are these new construction and 4-bedroom, 5-bedroom, larger homes that are driving prices up. And so again, and look at 1-bedroom. I mean, just the apartment market is decimated out here. And so essentially this is just showing what we're talking about, that there is not enough housing entering the market. You've got all these people moving here, all these jobs relocating here, all the new jobs being created, and our housing units are virtually unchanged. Now, this is the interesting thing talking about inventory. So I've gone ahead and provided the full chart for you because there's a lot of news talking about how inventory is at all-time highs. It's up 140%, blah, blah, blah. I want you to see that we are in line right now with 2017. So despite the fact that this area is doubled, despite the fact that we have hundreds of thousands of people moving here, just looking at a snapshot of Grayson County, our inventory is almost identical to 2017, and we're actually below 2019 pre-COVID. So again, it's all how you skew your numbers.
Wow, thank you. That was exciting. Every time I hear you talk, I get more and more confident. and how this is going to go. So fund update. I know you've been very, very busy acquiring. So why don't you kind of go over this slide and what you've been buying and why you're excited about it?
Yeah, so we currently have 11 properties, 10 single family and 1 multifamily that we have already closed on. We have 7 single family homes in Sherman. We have 1 duplex in Sherman. We have a single family in Farmersville and 2 single family in Denison. We currently have 2 of these homes under rehab. All of the others are already occupiable or already occupied. We actually were able to acquire a package of homes, and we got these below market, and it was just a fantastic deal that we negotiated down because of the volume of this package. And so we're very excited about having these stabilized properties in the portfolio, and certainly excited to see what values do.
Okay. This is small and hard to read, but anything in particular you just want to kind of show the basic numbers? It's far,
Yeah, so
far
really,
below the median home price that you were showing.
oh yeah, yeah. So what I really want you to pay attention to, and this is all in a PPM, guys, so you can look at more detail as we acquire properties. Of course, all the documents for new subscribers get updated. I want you to look at the average price that we're all in on these properties for. So pretty incredible. That duplex, 222,000. Single families anywhere from 137,000 to 164,000, with the exception of the one in Farmersville, which, by the way, guys, is in Collin County, and this is a massive, beautiful, over 1,800 square foot home, under 200,000. So we are very excited about our all-in and these deals that we have acquired. So here's an example of one. Beautiful house, heart of Sherman, right by TI, great location. And you can see same. Oh, go ahead, Kathy.
How long did it take to renovate this?
We actually bought this already renovated.
It looked like this.
It looked just like this.
That's amazing.
This is a duplex. We picked this one up for under 230,000. So again, incredible, incredible opportunity. 2 bedroom, 1 bathroom per unit. Again, already renovated.
I imagine our listeners will want to know why anyone would want to sell these to you at a discount.
Why does anyone sell to me? You know, a lot of people don't want to be individual landlords, and a lot of people, especially the ones that we buy from, have owned properties a long time. And so they've already been in this area, they've already seen massive appreciation, and they're looking to do something else. In a lot of cases, the people that sell to us are working on development and building up here because, of course, there's so much opportunity and they want that capital available for new construction building. And so this particular person that I bought these from is actually a builder. And so it's just everyone has a different situation. Some of the homes that we acquire are like the home that we bought in Farmersville. It was a lady who was in dialysis and had to liquidate her home. She couldn't take care of it anymore, and she wanted to see it get revitalized and get, made the way it was when she first got it. And so to her, it was something that she didn't have a choice. But then there are people who are just looking to put capital into other places that maybe they can't qualify for a refinance, but they have lots of equity in the home. There's just so many different stories with every property. But at the end of the day, what we focus on is what are the numbers and what is the deal. And of course, we are blown away with what we were able to acquire for the first 11.
Okay, so for anyone who's not in the fund yet, I'll just go over sort of the business plan that we have and answer some of the many questions that came in, which again, we love your questions. Our business plan is to acquire 1 to 4 unit properties, renovate with high-end finishes, unless that's already been done for us, and lease to highly paid professionals in rapidly growing markets throughout North Texas. The target return is 8%, and that's per year. We're going to change that on the website on Grow Developments because there's been a lot of questions. When I had a single family rental fund come to me, they wanted to partner with me, and they had a target 8% return. After many, many questions, I'm trying to understand how they were coming up with their numbers. It was 8% total over 5 years. So a very, very low return. And that is not what we're talking about here. This is annualized and a 3 to 7 year hold. So do you want to kind of explain why such a spread, 3 to 7 years? Why would you sell at 3 versus 7? And vice versa.
Yeah, so It really is going to depend on how much the market goes up, right? And so a lot of these projects that are happening are not going to be completed for 3 to 5 years. And so I anticipate we're going to hold for 7 years. If you put my feet to the fire, that would be my best guess, because I think we need to give the market time to see all the benefits of what's coming. But look at what happened with COVID. Overnight, things started to change. And if we start to get an inkling that something like that was happening at year 5 or year 6, we might decide it makes more sense to liquidate. Or we might look at it and see that we went from, a massive amount of appreciation to a reduced level of appreciation, and we have so much equity, it makes sense. And so there's going to be a lot of factors. And of course, we're going to be talking to you as we're making these decisions so that you know where my mind is and what we're thinking. But our intention is to hold for the full 7, unless the market dictates otherwise. The one thing I will say is anything that we do sell before year 3, which I don't anticipate doing that, but if we did decide to do that, say one property had so much equity or it made sense to do so, that is automatically reinvested back into the fund. But anything we sell after year 3 is distributed back out to the investors. And so that is kind of that 3-year cusp, that timeline. And depending on where the property is, what the property is, I have some in my portfolio where I have properties that I'm all in for 180, 190,000. And a few years later now, I think it's been 2.5 years, one of them is worth $330,000. And that property is actually in Greenville, one of our target markets here. And that property, the rent just doesn't keep up, right? As your value goes up, rents go up at a slower rate. And so it just didn't make sense to hold it. And so although I'm a long-term holder, I don't really 1031, I'm selling that property in March when the lease is up because it makes sense. And so when we look at a fund like this, the great thing about diversifying the risk across lots of properties is we could treat each property as its own investment and make the right choice for that property based on the market at that moment. And so typically what I would expect to be the reason for the sale is that value gets so high that the rent doesn't justify holding on to it.
Okay, so the business plan again is that we're not paying retail for these properties. It's forced appreciation, which means we'll be creating the built-in equity in year 1. Again, unless Leah is able to negotiate a deal where that equity is in there, but we didn't have to actually do the renovations. Discounted properties in the path of progress, renovating to high standards to attract professionals that will be moving to the area, many of them from California. Cash flow investors will receive cash flow distributions from rental income quarterly. That answers some of the questions. It will be quarterly distributions once it's stabilized, and after 2 quarters when you first invested. Profits, given the extraordinary growth in the area, we believe these investments will grow in value over the next 3 to 7 years, and of course you benefit from that. The manager will consider the following property types: new homes, previously renovated homes, properties needing renovation, predominantly single-family homes or small multis. And it's diversified fund of residential rental properties, diversified in the North Texas area. So still very targeted, but you don't have, it's not like an apartment building in one area. It's all over, spread out in that North Texas area. Current cash flow and long-term appreciation is the goal, and high growth markets in North Texas. I was just there for the tour in December, and I just couldn't believe I had my camera out. I should post it on the website. I had my camera out when we were driving down the freeway, and it was just miles and miles and miles. I felt like it was 10 minutes of video of this freeway expansion, which is one of my favorite things. When I see freeway expansion and cranes and huge businesses being built, that's a really good sign. That's what I'm looking for, and that is what's there. Streamlined vertical integration of the company operations. Leah and her husband Michael own a property management company, so that's an awesome benefit to us is they know the property management company because they own it, and with that they know where the rental demand is, and that is just such a value bit of expertise, and access to significant deal flow as a result, because they do know so many investors that that they manage the properties for. So why rental housing? I think anyone here knows why. Potential for appreciation, cash flow, passive income, stability and control versus other asset classes. Hedge against inflation, really important these days. Ability to leverage to purchase more. It's insurable, and of course the tax benefits. Acquisition review process. You want to go over this part?
Sure. So the typical investment will have the following characteristics: 5% cash on cash or more, 2+ bedrooms, 750+ square feet, 1,200 plus average monthly rent, and values from 155 to 280. And that's just kind of what we call the buy box of what we're looking for.
Okay. Debt financing in the first year of operations, we intend to purchase all investment assets with cash. And once the investment portfolio is stabilized, which we expect 12 to 18 months, but could be sooner, we may evaluate and then, the interest rate environment and the economic environment to see if we want to refi and buy more. What are your thoughts on where we are on that, Leah? Are you anxious to
Yeah,
refi?
so here's the thing. We ran our numbers. What we're projecting is based on cash acquisition. So anything we do to refinance this and finance this just increases our returns. So I'm not in a rush. I want to give rates time to stabilize. They're already coming back down. We're already seeing Fannie Mae back in the low sixes for investment properties. And, we're already getting bank loans back in the sixes for our investments. And so I want to give it time. We're not in a rush. We're ahead of schedule in that we have so many properties already stabilized and occupied. But on the same token, that little bit of rate difference does make a huge difference. But ultimately, the goal is to have as many properties as possible, especially when we're banking on growth of the area. So as soon as it makes sense to refinance, I do anticipate that's what we're going to be doing, and probably in batches versus having to do one big batch. And so we'll just keep you guys posted as we move forward, but just know that what we're projecting right now is cash acquisition. Anything we do to leverage and go buy more just makes it go up from there.
Great. Minimum investment is 50 units or $50,000, though if you are just new to real wealth or new to getting to know Leah and you want to come in for less, we can have a discussion about that. Total offering max amount is 20 million, minimum raise 2 million, which of course we've done. And deadline is 120 days from published date with 60-day extension. So we've already done that. The offering close date 9 months with a 3-month extension. And again, accredited investors only. Distributions, lots of people had questions about that. It's the amount equal to 100% of capital is returned to the investors first. So your capital gets returned first with any distributions. Once that's met, then 75% of company profits go to the investors, pro rata, and then 25% of remaining company profits to the manager. All distributions are made at the manager's sole discretion after expenses, fees, and allowing for any reasonable reserves. Investor distributions are paid pro rata. The manager expects to provide quarterly distributions starting 2 calendar quarters after funds are deployed by purchasing the real estate assets. And in order to give preference to early investors, each investor member will start sharing in profits after it's been after that person has been a member for 2 calendar quarters. Fees. All right, you want to go over this one?
Sure. Manager will be reimbursed for expenses. The annual asset management fee of 1.5% of total asset value under management, calculated and paid on a quarterly basis. Acquisition fee of 4% of the total of the purchase price of each asset invested in and purchased by the company, and the repair renovation costs invested. So we are getting these at actual expenses. So we're not charging a fee for overseeing renovations or handling or any of that. So that's why there's this acquisition fee. Disposition fee of 1.5% on the sale price of each asset. If financing is obtained after stabilization, refinance fee of 1% of the principal amount of the loan. Guarantor on the refinance of the portfolio may receive a fee up to 2% of the principal loan amount for providing said guarantee. Marketing website platform fee of $25,000 and $250 per subscriber. And manager will receive 25% of the profits of the company.
Okay. Timeline, we went over this already. Capital raise within the first 3 to 9 months. Portfolio stabilization around 12 to 18 months, holding 3 to 7 years, most likely refinancing within that time. Potential risk, this is a blind fund. No assets have been identified or purchased, but we're really specific on the buy box, so it's a little less blind than others. You really know, basically, they all look the same at this point, right? I mean, I don't know if people would even know the difference between the properties, so very, very, very clear buy box. Unknown if sufficient properties that fit the parameters, but so far that has not been an issue, and I don't think you think it will be. Limited geographic diversity, as all properties will be in North Texas. Still pretty diversified though. And illiquid investment, this is important to understand that when you invest, your funds have been deployed to purchasing property. So this is not kind of an in and out fund when you want. Everybody gets out together at the same time when it makes the most time to sell. Changes in market conditions such that homes do not appreciate as anticipated. You just never know what appreciation rates are going to be or what's going to happen. Based on everything that was said earlier, we feel very, very strongly that there will be appreciation based on all the job growth and the lack of new housing to support it. However, you just never know, but we think there'll be some good appreciation. And then, of course, reliance on key personnel. But I'm not too worried. Leah is married to Michael, unless you guys go heli skiing like I just went with my husband. Yeah, I think we'll be fine.
I can't even get him to play tennis with me, Kathy.
Well, lucky you, because I found myself on the top of a mountain in the middle of nowhere in a storm. So that was exciting on a big avalanche day, but I'm back and alive. Reporting business activities such as purchases, sales, and refinancings, key information about assets under management. This will all be in the quarterly reports, the status of development, quarterly unaudited financial statements, information reasonably necessary for the preparation of your income tax returns, including K-1s, and other such periodic reporting as provided, because we're going to be excited to be sharing all the acquisitions. So we will be giving updates much more frequently, especially this first year during the acquisitions phase. Our team to help you walk you through the very, very exciting paperwork of the PPM and the operating agreement and how to upload it and how to verify your accredited investor status. All of that you will be handheld with Ann and Kathy. Ann's been an investor in many of our projects. She really understands the process. She's been helping investors for years. And same with Kathy McBride. Many of you probably know her. She's been helping answer investor questions as well for, again, many years. So they are here for you. And you can send questions to syndications at actually it's growdevelopments.com. Yeah. That was a little typo there. Okay, so there are questions, and we're going to probably just fly right through these. Short-term rentals in Grayson County, is there a travel nurse scene to be aware of? Is this part of our strategy or something you recommend?
No. So my investment strategy is and has always been stick to what you know and stick to what's stable. Through COVID, of course, short-term rental housing and all of that was decimated. I personally owned a beachfront home in Florida and saw that firsthand. So again, we're looking for what is going to be the easiest on these assets from a WARE perspective and what is going to be the most consistent in income. And so long-term rentals is what we are talking about here.
Okay. Can this fund take a 1031? No, I'm so sorry we cannot on this. I wish we could, but if you're in the middle of a 1031, Leah will be happy to help you outside of the fund. And I really recommend that because she has properties available. You're not going to have to sit and wait and try to figure it out. And always over-identify just in case some property doesn't work out. Make sure you've got a backup plan. I can't emphasize that enough. Is this fund open to buying properties from real wealth investor owners, properties that were bought via real wealth providers a few years ago?
I would be happy to take a look at the numbers, but likely what my advice to you would be to sell at full value on open market, not sell to a fund. Yeah, because remember, we're not buying a market.
Yeah, we want discounts. So if you want to discount it, 30%, sure. Don't do that though. Okay, most of the news clips and data and announcements are pre-slowdown. Has hiring slowed or stopped for the companies in Grayson County as of December 2022? So over the last month.
So pretty much everything that I presented is new, and no, absolutely nothing has slowed down from an employment standpoint here. We are in a massive employment. We have more jobs than people going into them. And so obviously there are companies laying off, but it doesn't change the fact that there's more jobs than there are people to go work them. And all that data was new. Pretty much everything was within the last 60 days.
Somebody asked where the Texas Instruments new plant is being built. We drove right by it. We have all the pictures. We need to make sure we put those in the next PowerPoint, although it's probably so much further along at this point.
It is. It is.
Well, it was right off right off
75.
75.
Yeah, it's right next to where their existing place is. So for those of you who don't know, they had a location in Sherman and they had one in Allen, and they started moving people from Allen to Sherman with kind of the talks of, are we even going to keep Allen, once they realized how close it was. And so the new development, it's like right next to their existing one up there.
And it's massive. We just
Yeah,
could not believe
it's
it.
huge. However big you think it is, guys, it's bigger. It's like you just drive minutes and you can't pass it.
Yeah, we were shocked. Investors will get K1s. What is the target return? What does that mean? That means that when we liquidate and in 5 years, our target is that you're looking at having earned 8% per year. So a simple way to look at that is if you invested $100,000, our goal is that you would be making about $8,000 a year during the time that you would be holding it. So 8% per year. Again, anything can happen. We are hoping and expecting it'll be more, but we would rather under promise and over deliver. About projected returns, the annual 8% is projected annual cash flow. You want to explain the cash flow versus the appreciation on that 8% return?
Yeah, so it really, at the end of the day, it's going to determine a lot of factors. Are we going to finance at the end? What is the appreciation going to do? And so where we end up at the end is going to be very dependent on what happens with the market and what happens with the refinancing, which is why we presented numbers not including financing. So again, it's just going to determine by what the market does. And then when we go to refinance, how much we refinance, because what's likely going to happen is where values are going to be is not where we're going to refinance out, because again, rents don't keep up with value increase. And so there's a lot of decisions that'll be made over the next 12 to 24 months when it comes to the refinancing to decide how we're going to proceed with that. So I know we looked at what the numbers are with refinancing. It's a lot higher, but we also want to take into consideration what that does with interest payments as well, as long as interest remains high. So the goal is a minimum of 8%. We're anticipating it's going to be significantly higher than that. But you know, when we put this together, we were in the middle of a very unique time with inflation and interest rates, and we wanted to be overly conservative. And so that's what we've done.
Will increased property tax cut into those returns?
No, we've already calculated property taxes in there, and on all the properties essentially that we're looking at are infill locations. And so they're pretty behind in what actual value is relative to where the bills are. But we also have built in increased as an expense factors too. But remember what I just mentioned is that Grayson County just did a massive tax decrease to help offset the increase in values. And so I think that's probably going to continue. Again, these cities have more money coming in than they've ever had before. And so the counties, the cities, they're all trying to do what they can to keep property taxes from increasing.
Here's a good question. After 7 years, is the exit strategy to sell the properties and close the fund? The answer is yes. However, funds can do a 1031. So if there was 100% agreement that we just sell the fund and go do it again, then we could. But at this point, it is liquidated in that 3 to 7 year time period.
And I think, Kathy, there might be opportunity, correct me if I'm wrong, but if we get to that point and there's a couple people that don't want to sell, they could be bought out in theory if we get to that point.
That's true. How are fund investors protected from a lawsuit?
So insurance, obviously these properties are insured and there's liability carried on the properties as well.
And you're holding a unit in a limited liability company. So always speak with your attorney about that, but you have the added protection of the LLC and you're a limited partner. So you're protected, but speak with your attorney. Are acquisition fees, disposition fees in lieu of or in addition to realtor sales commissions?
These were all bought off market. There was no realtor commissions on them.
That's pretty fantastic, you guys. Leah's giving up so much. I mean, she could absolutely have charged a fee for that.
Yeah, but this is why we were talking about too, we're not charging for overseeing rehabs either. So like we have 2 properties in rehab right now and you're paying actual costs. So all that extra equity that's left sits on the bone for all of us. And then on top of that, we've made it even more worthwhile because we're paying back all your capital before Kathy and I get a distribution. So we're, again, trying to be as conservative as we can for all of you, knowing what climate we're just coming out of.
Somebody said I live on the East Coast. Does it make sense for me as an investment? And we've got lots of East Coasters. New York is kind of a tough state. It's an expensive state, but we are still allowing people from New York. Every state has blue sky laws, but absolutely, we have investors nationwide and actually worldwide. Allow investments from self-directed IRAs? Yes. Do you feel there will be a surplus of 3-2 rental homes in Denison and Sherman with all the new houses in that area?
So again, 8,000 new jobs doubling the population in 5 years, going from 54,000 to 108,000. I could sell a dozen properties a month every month for the next 5 years and still not even make a dent in what's going to be needed. Just sheer math, guys. 54,000 to over 100,000 people in 5 to 10 years. That's 50,000, minimum 25,000 homes. I don't know where they're going to build them. I have no idea. Their plan right now calls to build 8,000 homes in like the next decade. There's a massive shortage. There's nothing any of us can do that's going to fix this problem. And as I showed you, we're in a shortage and we're not even keeping up with increasing the shortage.
How long is it taking currently to rent out the houses on average?
So these homes, because we're talking entry-level renovated older homes, they go very quickly, very, very quickly, because there's just not a lot of competition. And we're also coming into prime season. So strategically, the closing of these properties was very time specific as well. But again, keep in mind, almost everything's occupied already anyway.
What's the overall percentage of debt in this fund already? Zero. We're raising raising the money and purchasing with cash, which is what's giving us an advantage as well in the negotiations. If you can rank Sherman versus Denison, which is number 1 and number 2 for you?
I don't even look at them as different cities. I really don't. Like, from a renovation standpoint, Denison's easier to deal with. So maybe that gives Denison a bit of a heads up or a leg up when you're gutting a house. But for numbers and everything else, I really consider them equal. Sherman's values are a little bit higher, but there's less inventory and a little bit older. I think that the downtown and infrastructure coming into Denison is slightly superior. Sherman has the jobs. Denison has a cuter Mayberry appearance that a lot of people prefer. Again, it's just, they're so similar. We call them sister cities, and I really look at them as one and the same. Where the differences are is in the city council level and the permitting level, but both of them get done. It's just Denison is a little bit easier.
Cash flow distributions are quarterly. Can I invest in 2 different deployments, or is this a one-time investment?
You can certainly, if you've already invested, you can increase your investment.
Until the 9 months is up, or maybe
it's November. Yeah. November's our drop dead, I believe.
Yeah.
Yeah.
If investing in a self-directed IRA, would there be UBIT or UDFI? I would say talk to your CPA about that.
Yeah.
You don't want to hear it from us. Definitely, it's going to just depend on everybody's situation is different. And for those who don't really know what UBIT or UDFI is and your self-directed IRA, it's a business tax or finance tax within your IRA, but it depends on a lot of things, your income, the value of your IRA. So just talk to your CPA to see how that, if your IRA would get taxed investing in this. I'm sorry if someone asked, but do you see moving to more of a 2-plex or 4-plex portfolio versus single family?
No. Single family will be the majority of holdings. That is the best return. It's the most stable, and it also is the easiest to liquidate. I love small multifamily. I own plenty. In fact, I own 10 and 24 unit apartments. So I understand the benefits of multifamily from an economy of scale perspective. But again, we want what there's the largest pool for, especially given that our exit strategy is to sell these to top dollar owner occupants. And so we will be putting in as many single family as we can. However, when I get the opportunity for an incredible duplex renovated under $230,000, I'm certainly not going to say no.
Do you plan to buy future properties with cash for this fund?
Oh, yes.
Yeah. We're still raising money for it. So if you're interested in participating, you could be a part of that. It is a closed
And we just
fund.
started too. So I will tell you that. So for those of you that are worried about the preference to early investors, we've just closed. And so really at this point, it's a great time to get in still, although we will be raising for another 10 months or so. It's a great time to get it because we're just closing on the first properties.
And the fact that we are not accepting investor funds after we reach the 20 million or until November means it's a closed-end fund. And that's important because the whole Ponzi thing that, new investor money kind of replaces the old money and so forth, that tends to be an open fund where you can keep accepting investor money ongoing. I'm not saying that all open funds are Ponzi's, but if you're in a closed fund, that eliminates that as an option. Yeah, okay. Thank you for allowing us to participate. It was nice meeting you both in December at the tour. Leah, I noticed you have several properties in Greenville. Do you expect similar growth there?
Yeah, Greenville is a great area too. It's just very, very hard to find quality properties there. What I find it's interesting in Greenville, when we're working with new construction, it's great. And I love Greenville and recent builds. But Greenville just doesn't have the amount of inventory. People don't move, and there hasn't been a lot of movement, and there's just not as many homes. And so it's just harder to find ones that meet the numbers because the market's higher. So, for example, I scoped like 10 in Greenville last week, and ones that need renovation, 3-bedroom, 1-bathrooms, 2-bedroom, 1-bathrooms, we're still close to 130. And so by the time I do my renovation, why would I do that when I'm all in Denison and Sherman for 150 for the same return? So it just doesn't make sense. My hope is that we'll find some good ones for the fund, but at the end of the day, I think it's very clear that the main target needs to be Grayson County. And certainly with my own portfolio, my main target has been Grayson County as well, and northern Collin County. So Anna, Melissa, Farmersville, Blue Ridge, all those areas around there, they're just going crazy. Collin County's going crazy. And so, you know, the top 3 highest rents in Texas are Collin County, Plano, Frisco, Allen. And so I think that speaks volumes to what's happening out there and why all these areas around them are doing so well as well. It's all about what comes across my desk. It's the best deal. Whatever the best deal is, that's what's going in the fund.
Are there any income tax benefits for investors in this fund?
That's a question for your CPA. The short answer is yes, should be, but you need to talk to your CPA.
Yeah, just take the operating agreement and the PPM to your CPA, and they'll read that section to see how it applies to you. But it is a pass-through entity, so we're passing on those benefits to investors pro rata. You are welcome. Thank you. We're out of time, so we have to wrap up. There was a bunch more questions, so we will do another one. And I'm not sure when that date will be, probably next week or the week after, to answer more questions that came in. But Leah, thank you so much for sharing again all your passion and excitement about the area you live in. I wish I was living in such a affordable growth area, but that's why we partner with you. And thank you all for joining us here and for participating in the fund. We're really excited. We'll plan a tour again soon. I think it's really important to get out there and see it for yourself. I already trusted Leah and already knew that there was growth in the area, but when I went to drive through it, I was even more mind blown because some of the areas that were just weeds and fields when I was there last are beautiful centers now, with expensive restaurants and beautiful corporate headquarters and amazing shopping. So you got to get out there. So we will plan that as well. All right. Thank you, everyone. Have a great rest of your afternoon, and we'll talk to you soon. Bye-bye.
Bye.